Hey everybody, we're live. I'm with Victor. I'm sure everybody knows him by now because we've done a few live streams together, and we have a pretty small, solid group of people. And but if you're new, let me know. We always like to get some new people. But Victor has been motivating me a lot because I started doing this I remember the exact day, May 17th, 2020. That was my first video for this channel. And I was for a good 2 years, I did a video a day for 2 years. I was so motivated, but lately, I'm not as motivated. I still make lots of videos, but I used to be so excited to make videos and growth. But, you go through those swings. But Victor's really motivating. Secret sauce, you just got to do it and be consistent like anything else. Of course, if you're naturally good at something, you'll probably progress more than the average person. But even if you're not naturally good at something, like say playing basketball, you can still be good. You might not make the NBA, but you could still be really good if you practice all the time. Okay, Victor, you want to just introduce yourself in case anybody doesn't know who you are?
Yeah, I'd love to, Scott. First, thanks for having me. It's great to be here. It's always great to have a conversation with you. And, to all the regulars, I look forward to seeing what you guys have to comment on. Scott was mentioning about making videos, and I certainly do that. And I also have live streams. And probably one thing that really always I come away from live streams on is the connection to other investors and getting those questions and getting that energy, that combined energy of, hey, cool. I found another company that I hadn't heard of, or maybe we analyze a company and help each other kind of figure that company out. So I look forward to seeing the comments. And I think you guys know I've got a channel. It's similar to Scott's, where I'm an individual investor and I share my analysis. I also share, my observation of the market on my channel.
Nice. I've been doing what I've been doing lately. I pick a industry. It's kind of random. There's no thought process. I just look down the list of industries, and this week I saw electrical equipment and parts. It's also efficient to do one industry and to pick 6-7 videos, because then I could this chart I create. Great. I don't have to do it 7 different times. So I did a video. It's coming out. I think Vertiv came out today. And this is a SPAC. This is crazy because SPACs are really, really risky investments. Over 90% of SPACs have gone down 90% in value within the first 2 years. So it's what's your opinion on SPACs? Let me. I have my theory on why they suffer so much, but what's your opinion on SPACs?
Let me tell you what I don't like is, so this is what I love about Meta, okay, is somebody had a great idea and they took that idea and they created this awesome business, and somebody else had a great idea and they created Google search, and somebody else had a great idea and they created Microsoft, and that was Bill Gates and the late Paul Allen. So those companies started with great ideas, great creativity, knowledge, intelligence, period. A SPAC starts with people asking for a bunch of money, and then they're going to figure out what business they're going to be in. So to me, the beginnings of a SPAC versus the beginnings of a great company are very different. And I look at SPACs with a different lens, more skeptical lens, like you were saying, risky. And it's primarily for that reason that, when I look at Uber, somebody really had a great idea and they made this business a reality, and it transformed the taxi and the transportation industry. That's why I love those types of companies. And that's why at the same time, SPACs, I really am skeptical about.
It's so true. Let me just define. I know this is kind of what I do because I feel it's an educational channel, but I'll just do a quick definition of a SPAC in case you're watching and you're not exactly sure what we mean. But I have a feeling most people are sure. So it stands for Special Purpose Acquisition Company. And if you know what a reverse merger is, then this is what a SPAC is. It's a reverse merger. But if you're not sure what that is, it's the easiest way to become a publicly traded company. Because if you have a business, right? Say you started a business selling sofas, couches, and then you grew and scaled the business and has $1 billion in sales, and you want to become a publicly traded company. It's very it's time consuming to become publicly traded. It costs a lot of money. There's legal fees. There's accounting fees. There's a lot of fees and things you have to do, and you have to pay the exchanges just to be listed. But the quickest way, the fastest route to becoming a publicly traded company is to be a private company and then get acquired by a public company. So if like Microsoft acquires some ABC company, that ABC company is now part of Microsoft and it's now a publicly traded company. But Microsoft is so huge, this little ABC company is meaningless. It wouldn't even move the needle on Microsoft's revenue and stuff like that. So what they do is they create this shell company, which it's just an empty company. There's no operations, there's no revenue, there's no employees, there's nothing. It's just a publicly traded shell company. And what this shell company does is they look around for private companies, small companies. It could be a regular mom and pop company. And when they find that company, then they acquire them. So this private company X acquired by a shell company, and now this new entity, this SPAC merger, is a publicly traded company. So company X becomes publicly traded. That's pretty much what a SPAC is. But the thing is, that private company probably wouldn't have become public on its own because there's a lot of rules. You can't just become public. You have to have certain criteria in place. But this way, they become public. And some have done okay, and some have done really well. And I'm just shocked this Vertiv is the biggest company in the industry with 34 billion market cap.
Yeah, I'm looking at it.
and it was but if you put your money into SPACs, you eventually would lose all your money because they usually just suffer. And if you look at a stock chart,
I would ask has there been a SPAC that's been like a wild success?
Besides this one, I can't successful. No big. Okay.
Yeah, this one's been really good. 300% in a year.
Company. There's some that go up like 1,000%, and then they go down like 99% right after that because there's a lot of hype. But this went pretty much every SPAC. It's not a rule, but like I'd say like 95% of SPACs start at $10. So if you're looking at a stock chart and you see this flat $10 for a few months or even sometimes a year, it was a SPAC. It started as a SPAC. Because what happens is this shell company is $10 and it doesn't move in price because there's nothing going on. Then when the shell company announces, we found an acquisition target, and it's this company called Vertiv. They do electrical manufacturing. Then usually what happens is a stock, sometimes it shoots way up, just the announcement. But this didn't really move too much. It went up a little bit to 13, then actually came down to 7. And then it kind of like just hovered around that $10, $20 mark. And then look at it now. It 10x at one point. It was over $100. So yeah, SoFi is not a SPAC. SoFi is not a SPAC. Is SoFi a SPAC? SoFi stock is one SPAC. Wait.
See, like Vertiv, right? They do cooling, and data centers need cooling. Now, part of, I think, the appreciation in Vertev is the AI momentum, because they're expected to do really well. And you can tell by their kind of like the way they're describing their company, they want to kind of ride the momentum of AI. Now, are data centers really growing this fast? I study, like Dell would say, no, they're not growing that fast because we're only growing at 6%. And if you go to the companies that truly are telling you what the data center is doing, they're not growing that fast. Like there's a real estate investment trust that's called Digital Realty. They own data centers. That's all they do. It's a real estate investment trust. That's a really good one to look at and see, well, if NVIDIA is exploding and all these other companies are exploding, then data centers must be like doubling in the number of them. I don't know, every year, every 2 years, but it's not the case. They're growing very slowly because data centers are really expensive, hard to build. Once you build them, it takes a lot of time. So I'm still skeptical of Vertev. I think they're in the right place, right time with a bunch of money. I think their product is not that I would say sophisticated, and it doesn't have a big moat. It doesn't have a lot of competitive advantage like an NVIDIA. NVIDIA has the IP behind their semiconductors. Nobody can copy it, or they'll sue that company until they get them to stop. These companies are doing cooling. It's like, okay, that's not that difficult technically. You're just doing it and you're the right place at the right time.
Right. Yeah. That's true. I'm not a big, well, Buffett likes moats, right? When people talk about moats, I think it's hard to get a moat. Like, I don't think a moat, like, I think it's really about the brand name. I think that's the only way to get a moat. Like Coca-Cola has a moat because it's such a powerful brand. Because you can have $1 trillion of trillion market cap, be a massive company, and not have a moat. You're just selling a lot of products and making good margin. But anybody can really take over anybody. And of course, it takes a long time. Like people always say, like, oh, Netflix, what's the moat? Why can't just like Google start streaming and things like that? Of course, anybody can do anything. And, a Google or an Apple, they have enormous amounts of money to try to compete. Apple tried to compete on EV cars and they failed. So you can try. It's really hard to do. It's just do a streaming platform and compete with Netflix. It's easier said than done. But they're starting to get to a point, Netflix, where they have this great brand name. It's almost like Kleenex, where Netflix. Okay, it's streaming. It's like synonymous with streaming. Disney, you don't think of streaming.
I would say that I think you're right that, like, for example, an example of somebody having a total unique product that nobody can replicate might be like a pharmaceutical company, right? Like you create a drug and it's very hard to replicate it. And for, let's say, 10 years, you have this really strong moat because, people will potentially die if they don't take that medicine, or they'll live a very compromised life if they don't take that medicine. So that clearly is a big advantage. And that's a easy way to see a competitive advantage or a barrier of entry, right? A barrier of entry of a competitor coming in and saying, no, I have another drug that can take care of you, and so forth. Now, the one thing I like to do is I look at the top 10 most valuable companies on the stock market. And I would say that having a barrier of entry into your marketplace, whether it be a super strong brand or a technical advantage that can't be overcome by competitors, or some IP, or in the case of pharmaceuticals, you have a patent that prevents people from copying that idea. I think it could be the most valuable companies. Most of them tend to have really strong barriers of entry. If we look at the top 10, the one exception being Berkshire Hathaway. They're more just a brilliant, a brilliant group of people that invested for, I don't know, 60 years and have been really successful.
Yeah, I think a big thing with barriers to entry, I think I think the main thing is cost, because anybody can compete with Amazon, right? I can sell things online. It's very easy. Actually, a lot of people do it. But in order to do it where you get hundreds of millions of people visiting your website and you build a state-of-the-art logistics center, that's a different level. But you can do what Amazon does, but you can't do what like Boeing does. You can't stop building aircraft. Like
there's two competitors in that field. There's Airbus and Boeing.
Yeah.
Coke or Pepsi.
Yeah. Like you can do a lot of things like what companies do. It's actually pretty easy to create one thing. Like to create one phone, if you obviously have to understand electronics and you have to be good at those types of things. But to create one item is usually pretty easy if you find the right person. But to scale and market, it's another level, and people don't realize how hard that is to do and keep quality. Like to make one phone or to make one car or to make one thing, you can make it with great quality, but try making 1 million of those things and keep the quality the same.
Yeah.
It's hard. So that's what we have to do. That's what we're trying to do as investors, is identify these companies that can make 1 million products with the same quality and maintain their expenses. So they're good investments.
One thing I would add, like one of the things that I strongly believe in, and this is like a Peter Lynch philosophy item, is invest in things that you really understand. And Warren Buffett would be in the same boat, which is don't ever invest in something you don't understand. But where I'm going to go one step further, which is try to find industries that either through your experiences or your interest, you just have a passion and you have information advantage. And then you're able to determine, for example, Google search was not the first search engine. It was like number 100. There was search engines like America Online and Lycos and Yahoo. Yahoo was one of the main search engines, but they came in with better algorithms, and then they really simplified the experience, where others were just filling it with all this advertising. Their business model was, we're going to advertise so much to make money, and then the search is going to be free. And viewers like me were like, hey, I just want to get the right information. And people adapted Google's search. So if you're in the industry, meaning if you understand technology, if you understand internet in that time, because we're talking 20 years ago, you would have understood that Google's search was growing at a phenomenal rate and they were going to take over at some point. So try to find industries where you understand momentum. You understand that, hey, would an interesting case study that I've talked about in the past is, iPhone. iPhone is incredibly valuable to the point of $3 trillion for Apple. But the original dominant smartphone provider was BlackBerry. And they were around about 20 years ago. They had 80% market share. Today, Apple only has like 42% market share. So BlackBerry was more dominant. We used to call them crackberries because nobody could walk around without one. They were a $365 billion market cap company, one of the most valuable companies on the planet back when 360 billion was saying something. And what changed? Well, the user experience on the Apple side really began to catch fire, and BlackBerry underestimated that and didn't adapt. So some of these barriers of entry are maybe brands and market dominance, and I would say market share advantages. They can go away. Google proved it against Yahoo and a string of people, and Apple, and along with Samsung and other types of devices proved it against BlackBerry, that some of these will go away. As an investor, if you really understand a market and you can see these big events coming, you'll be a better investor and you'll make a lot of money because you would have bought Google when it was way less expensive, or whatever company is going to take over from another competitor.
Yeah, I'm just answering someone's question. N. Kiter, thanks for joining. That's a new name. I haven't seen you around. So someone said, what is iPhone sales as a percent of Apple's total sales? So in 2023, it was 52%. So it looks like it's around 50. In 2021, it was higher. It looks like it was about 55%.
But I would say you need to add wearables and services to that, because they wouldn't have wearables and services without the iPhone. You don't wear your earpods. You wouldn't probably buy them unless you had an iPhone, and you wouldn't buy the services on iPhone on the Apple ecosystem if you weren't an iPhone user. So I would point that out.
So, okay. So if you want to add wearables and services, 85%. But yeah, a lot of companies sometimes don't make money from their product they sell. Like, for instance, a good example is aircraft engine manufacturers like GE or Rolls-Royce. They make the engines for the aircraft. Rolls-Royce is actually one of the largest, I think the second largest aircraft manufacturer in the world. They actually don't really make much money, or sometimes they even lose money every time they sell an aircraft. They make all their money on servicing, because the companies, usually it's an airline, the companies that buy the aircraft engine need to get it serviced. So maybe once a year they sign a contract saying every year Rolls-Royce will service their plane, the engine, and that's where they make all their money and all their margin. So sometimes, like, companies, I think they make good money with the iPhone, good margin, but a lot of companies.
Yeah, services is all margin, man.
Yeah, it's all profit. That's
all they're doing is having another developer come on their ecosystem, and then they get to make money off of that. Google, Alphabet pays them, is it $20 billion a year, just so that the standard search engine in iPhone is Google search. $20 billion. There's a lot of margin in that, because they didn't have to do a lot to earn that, other than just staying the market share leader in smartphones.
Yeah. And something I just thought about, the printer, when I buy a printer for like $200, $300, $400, the amount, which is like only a fraction. Like, I'll spend, like, if I get a really nice printer for $500, the amount I spend in toner over the course of the time I have the printer is like $5,000.
Yeah.
So that's where they make their money. It's the so when you buy a product, or when you invest in a company, it's not that uncommon for the main product they sell to not even make money. It's these accessories, like, because it's so much more expensive to make a phone, like manufacture a phone, than to pick up the phone and just explain to someone how to fix something, and then you charge them a monthly fee to have that service where they will answer your questions. Or what did everybody think about Nvidia? Victor shorted it, and I respect that, because I was thinking of shorting it, but I think the trend is too strong, and I just don't know when it's going to come down. And it will come down. It has to. It's just simple math. Unless they grow at a pace, like, you can't grow. Like, I remember, Professor Damodaran from NYU.
Yeah.
Yeah,
I like listening to him. I think he has a lot of good stuff to say.
He's still the king of valuation, or something like that. Like, I remember he was doing talking about, was it I can't remember what company. I don't
He
think it was
sold his Nvidia stock. He sold
He
out.
did.
Yeah.
I can't remember what company.
Yep. So here's my story on Nvidia, and it starts with the fact that Nvidia is a great company, no doubt. The theme around AI is interesting, but it has no there's no proven ecosystem around AI yet. I mean, point to one company, and I'm talking about where people are using AI, and that company has a business model figured out. I know Meta is rolling out their AI. I've been using it. Google's had theirs through Gemini, and of course, ChatGPT has been out there. Those models are free. Okay, got that. Now, if you look at Nvidia and the rocket ship ride they've been on, at the rate they're on, right now they're 7% of the S&P, which is really staggering. And if they reach like 15% of the S&P, that'll be incredible. Okay. That means they would double in value basically from this point. So the way I view it is, I don't view it as a risky stock. If they were to double in value, I deserve to lose 100% of my investment. And I will bow to the greatness that is NVIDIA once more. I've already bowed to them 50 times. But I'm willing to bet my money that I'll be around 6 months from now, seeing a stock price that's lower than when I shorted it. And again, it's a small investment in my portfolio, but at a certain point, if I put so much time into analyzing companies, understanding the economy within these companies, I've made a lot of money on semiconductors. I've invested at the right time, right place with TSM, Broadcom, Qualcomm. I lost money on Intel. Now, if I really believe in my own research, I got to put up or shut up. And I put up. And you know what? I may lose money. I may make money, but I'm in the game.
Yeah. And you learn. That's the thing. So this is what he was talking about. I can't remember what a company was. I think it was like an exercise company that sold like exercise bikes. It wasn't Peloton. So he was talking about like how the company sold, these are in millions, like 50 million units, 50 million bikes. And in order to maintain their market cap, they said that they're going to grow at a 50% pace for the next like 10 years. And he said, but if you do the math, that means everybody in the world, like, because this gets to 4.3 billion units. So he said every single person in the world would have to buy a bike from
would
this
have to buy 2 bikes.
So it's just like, so when you think about things like the growth of NVIDIA, people always say this, when something is going up a lot, they think it'll go up forever. And when something's going down a lot, they think it'll go down forever. But the problem is, you can't go down forever. You can only go down to zero, of course. You can't go into become negative. But same thing, you can't really go up forever because you can't outgrow like the world, and especially if your product.
At some point, people will be like, we still need farmers to farm food, and we need the logistics companies to get the food to the stores, and then we need to go to the grocery stores and buy the food and then take it home, cook it, and feed ourselves. And we also need, transportation to get to work and back. Oh, and we also all the necessities of our economy, right? There's necessities, and NVIDIA is, in an exciting field, which is AI. My background, just so you guys understand, is I've been working in technology for 25 years. I've worked with big software companies. I've worked in this space. I am not an AI expert, but I do know enough to understand it, understand large language models, understand what their use cases potentially could be. Not an expert, but I am knowledgeable enough to understand it. So as we look at this space and we look at NVIDIA, there's two things. First is I believe NVIDIA has detached their valuation, their stock price is completely detached from valuation methods. And once you do that, anything's possible. Analysts could come in and say, oh, NVIDIA is going to consume half of the economy, half of the GDP of the country is going to be consumed by NVIDIA. And I laugh because literally that's what I'm seeing out there. And then, so it's detached itself. So you can't really say that stock price could be substantiated by free cash flows that the company is going to produce based on that industry. And secondly is that the stock price has so much momentum, but at a certain point, I'm hearing a lot of smart money begin to get concerned about NVIDIA. And, you know, it's one thing for retail investors like myself to say something. I mean, I buy, you know, tiny share amounts, but when big hedge funds start making moves on NVIDIA, that's where you're going to see the collapse in the stock price. And once a couple of the dominoes start to fall, you're going to see a lot of dominoes fall because nobody wants to be the last one on, you know, on NVIDIA. And you'll see it repeat, I expect, similar to the Cisco example I've provided in my videos, as well as the Intel examples. Both of those businesses were real, writing a real technology paradigm that ended up being huge, massive, but the stock prices just got way too high. And that's why I believe NVIDIA at some point, I don't know if it's going to be in 6 months or in 16 months, it will begin to go down. And I think it's going to go down significantly. And I'm not the only one saying that. I heard it from a respected hedge fund manager this week. She said the same thing. Even Jim Cramer has begun to comment that it's time to take profits within semiconductor. So, and I'm not the only one saying it right now.
And it is a cyclical industry, semiconductors. They're actually really cyclical. And I know everybody's saying it doesn't matter. It's different. NVIDIA is different. No one can touch them. They have such a strong, but they're in technology changes a lot. It's so every decade, like it's so different. New products come. Remember, you know, like when the phone came, the cell phone, like it was life changing. You know, to use a cell phone. Now everyone has one, but soon eventually that will get phased out. Like people aren't going to be using. There's other things. Like things just keep evolving. It's just it's crazy to think like that. But I don't know where the top is though. And every time it hits a new like record, like 1 trillion, 2 trillion, 3 trillion, I don't know where that top is.
I know. It's incredible.
Because I wanted to short Tesla for a long time. I'm glad I didn't, but let's see at what point would have been the right point to short it.
It would have been this past winter.
I know the peak was it was a while ago. The peak was October 2021.
Yeah.
But it's hard because like,
well,
it was 500.
If you look at it, Tesla, right? They had a recent high, and let me look at my chart really fast and then reference the right. Okay, so if we look at July 14th, it was at 281 a share, and since then it's down 36%. And around that time, I did film a video, and I felt that NVIDIA was highly overpriced, and they are a car company, and they've gone down ever since. They rise when Elon Musk makes a really big speech, and man, if investors are trading on speeches, I think the company's not worth much. I mean, it's more of a drama, it's a sitcom with drama episodes versus a true company generating great value. So I think recently it really provided an opportunity to short. So anyway.
Yeah. And I will admit, I didn't think they'd be as profitable as they are, Tesla. But even though they are generating, I guess 2022 was their peak, $7.5 billion of free cash flow, which is still a fraction. Like that's what Nvidia does each quarter, and this is for all 2022, or an Alphabet company. So they are generating more kind of profits than I thought they would, but it's coming down. You don't see this, like if you ever look at when you think of a really good company like a Microsoft, a Meta, and Nvidia, you don't see you see kind of an upward trend.
Yeah,
like they pretty much beat inflation, or they beat it by a decent margin year after year, because everybody buys their products. So this is not this, 2 billion to 7 billion. Now it's 1.4 billion. So I think they kind of peaked, and
you look at the competition that Tesla's faced with now. I mean, it's a different game. Like 3 years ago, their competition wasn't very strong, but now like Mercedes has really good EVs. You got Toyota with their good EVs, Nissan, and I could go down the list and show you 20 competitors that have a viable threat against Tesla, including the Chinese that are producing a really affordable EV. So with that amount of competition now, why would people buy a Tesla? I live in Southern California, and I would say that the consumer is kind of sick of Tesla. I think they're looking to buy a different brand because there's so many of them here. So I think the market's saturated with Teslas, and they're really feeling it. I mean, I'm not imagining the drop in sales. If you look at their drop in sales in the most recent quarter, they dropped 8.7%. And I think that's the beginning of a trend. So I think Tesla's in trouble from the top line of their automotive sales, competition, their margins and shrinking. I think the company, unless they come up with robotics overnight, they're going to be in trouble.
No, it's true. It's a tough industry, and without subsidies, it's really hard for these companies to compete, even with subsidies. But the hype has totally gone away. Like EVs was such a big hype in 2019, 2020, 2021. Now hardly anybody talks about it anymore. It's now AI is the big hype. But yeah. But is anybody a Tesla bull here? Do we have any? I know people are really big on Tesla. But yeah, they almost hit 100 billion market cap in 2023. Which is really good, but they're not growing though. Which, like in the first quarter of 2024, you see they're down like 10% from the first quarter of 2023.
And their net income in the first quarter went down 55% compared to the previous year, same quarter.
Yeah, 1.1.
So their profitability is shrinking, and they're losing revenue. It's like not good.
Yeah. But this is like the kiss of death for a company when they start. Not even sometimes revenue can still grow, but it's growing less. Like if a company was growing revenue at 20% and then they went down to 10%, sometimes the stock just crashes because investors look towards the future, and they just if it keeps going down each quarter, eventually it's going to be negative, which is definitely possible. But yeah, so I do not think you have the Chinese brands in the U.S. We have many Chinese brands here, none even coming close to Tesla. Chinese just EV companies in the world. Yeah, I know Chinese EV companies. There's a bunch of them.
Yeah.
When you say they're not coming close to Tesla, do you mean they're not as good as Tesla, or Tesla's not as good as them?
And keep in mind that the proposition that Tesla had 10 years ago, and by the way, I'm a fan of Tesla. I think what they accomplished was pretty incredible. It was really just to prove that EVs would work. And then the first Tesla owners, they really did have, I would imagine, a really proud appreciation of the car that they owned, because they were kind of like trailblazers. Now they're like everywhere. So, so it's no longer, oh, wow, having a Tesla is quite unique. No, everybody's got one. So now the proposition's changing to where I think a low cost EV makes a lot of sense for lower income people and younger people that are looking just for transportation. So instead of spending, $40,000 on a Tesla, you're looking for a $20,000 model. And that's where the Chinese can really come in and compete, along with the Koreans, which Hyundai and Kia, they put out really nice EVs. So that's the part of the market that's going to be very high growth, is that lower end of the market, because the upper end of the market, Tesla has their hands full because Mercedes has come out with a great EV. Cadillac's come out with a great EV. BMW's got a great EV. And I can go down the list of the premium brands have really embraced EVs. So they're going to be, kind of beating each other up, trying to take some market share in the EV brand. And really the opportunities in the lower end, I believe. And we'll see how things sort themselves out.
Yeah, it's I know people got crushed on like these companies like Neo.
Yeah.
The problem is, I know this is easier said than done, but try not to just always buy at the peak. And I know it's much easier to buy a stock at its peak because it feels like good because they're successful and they'll be more successful. But if you you could have made a lot of money with Nvidia if you bought at the peak in the beginning of the year. You'd triple your money. But these stocks, like I remember Neo, which one's Neo's the red one? Yeah, I mean it was up like 2,000%, and then so if you bought it like over here, you're up 100%. But most people don't buy it before everybody knows about it. Most people buy it when everybody talks about it,
right?
And that's why the stock goes up, because everybody's talking about it, everybody's buying it. And then you never really make money if you buy it up here, because it never hits that level again.
We don't know like what's going to happen next in that stock. And if you see a chart like we're seeing, where that red chart really went up, if I don't see fundamentals and if I don't buy into the story, I just can't buy, because my fear would be as soon as I buy, it just goes down. And then I didn't even believe my own research. I didn't really believe my own intuition. So I didn't learn anything. I just learned how to lose money without any lessons involved.
Yeah, it's but I didn't really see the fundamentals of the Nvidia. I didn't think they were that great 2-3 years ago. Maybe I should go back and look at it again.
So I owned Nvidia 5 years ago, and part of the reasoning was my now 19-year-old son, he was mining Bitcoin like 6 years ago. And he bought GPUs, and he explained to me that these GPUs came from the gaming industry and are now being used to accelerate computing and mine Bitcoin. And he did that, which was great. He did it for a year or so, and then he shut that down. Thank God he didn't burn the house down. And so that really caught my attention. So I'm a cryptocurrency investor, and I do believe in that space. I'm not pouring a ton of my capital in it. I think I have 6-7% of my overall portfolio in crypto. But I understood the space and started investing in Nvidia because they were an accelerated computing company. So I invested in them. But when I looked at their fundamentals, they just did not show this hyper growth. I didn't see it. So that's on me. I didn't see that the data center was going to grow this quickly. Their recent earnings reports have been tremendous. It's like, wow. You just have to like take a breath and go, holy smokes. Like their data center growth was like 260 or 70%. I mean, you don't see those numbers because they were already a significant size company, not the biggest semiconductor company in the world, but a significant size. So when you see those numbers, they were like, wow. But we always have to remind ourselves is this is cyclical. There's no semiconductor company that ever existed that has this beautiful chart like Microsoft that just goes up and to the right with regards to revenues and profitability. Never been one. It's usually boom, slow down, boom, slow down. And that's what I believe this AI build out is going to be. Companies are not going to build out large language models every year. They're going to do it one time and then say, okay, let's see if this business is going to work. Then they're not going to need to use accelerated computing to teach their large language models, how their AI apps need to function with it. So I think that when we get a year down the road, and as soon as we start seeing evidence that, hey, this hockey stick growth is not going to carry forward, it's going to be maybe a 1 to 2 year run, that's when the stock price is going to correct.
Yeah, I'm downloading all semiconductor companies. NVIDIA, let's see if they have the most revenue. They didn't for a while.
No, I think TSM is going to have the most revenue. I'm going to guess.
Taiwan Semiconductor was up there. Broadcom is up there. Wow. I didn't add revenue. Damn it. Yeah. So Intel had the most revenue for a long time, even up till like a year and a half ago. They really fell off a cliff.
Yeah, they did. What happened? It's like amazing that they could go that bad.
But they just can't keep up with these, because the old PCs, no one cares about that. They just care about
actually
AI.
So I own Hewlett Packard HPQ, which is predominantly PC sales. And if you look at their earnings, they did really well. Their last earnings, I think the stock popped 10 or 20%. The reason for it is that they see a recovery in PCs. That I think the whole conversation around AI, as well as other reasons, is creating a refresh cycle for PC sales. And the leader in PC semiconductors is Intel, which is one tailwind I think they're going to experience going forward.
Yeah. Damn it.
So NVIDIA is the top dog with revenue now. Wow.
Yeah, so they finally got number one in revenue. So they're
my guess was TSM, and because they've always been that big. It's not like NVIDIA quadrupled in the last 2 years. It's like, wow.
So in terms of Qualcomm is the most attractive. Because if you want to compare against their market cap, so Qualcomm is much more attractive. NVIDIA is trading at 40 times revenue. So when you see such high multiples, the assumption is that the market feels they're going to grow a lot in the future. And in order to maintain this market cap, they have to grow a lot. Like they can't just grow like 20%, 30%.
Hold on to that thought. And if you could do a sum on the revenue column of maybe the top 10 or top 15 semiconductor companies, and give us that number, and then tell us, we'll be able to say, oh, NVIDIA right now is 30% of semiconductor sales, or are they 50%? Because the statement you made is a very rational one, which is, well, the market thinks they're going to continue to grow at their rate, which means they'll probably be $160 billion company in a year or two. All right, what's the whole industry doing from a revenue perspective?
And when there's money to be made, a lot of people will jump into it. So of everybody, and the bottom ones are meaningless, I guess.
Yeah, and I think they're zero, so they won't.
But of the entire industry, let's see what percent of each one.
So 460.
So they represent 46% of the entire free cash flow, 49% of the market cap, and 17% of the revenue for the entire semiconductor market. So
if they doubled, which is like their stock valuation right now is like, oh yeah, they're going to double, I don't know, every 2 years, call it. In 2 years, they'd be 34% of the industry. And then it's just, I'm surprised that it's only 17. I thought it'd be higher, but.
They represent, 17% of all the revenue for every semiconductor company in the world. And Taiwan is like probably 16 or 15. So Taiwan is pretty close too. And then,
Taiwan's a different business. Taiwan Semiconductor doesn't hold the intellectual property. They're kind of like the world's factory or foundry. They get the IP from all the non-fabulous semiconductor companies, which NVIDIA is a fabulous company, meaning they don't have a foundry. And then they produce that. So it's kind of a different animal because they're not creating anything. They're just manufacturing. So that's why their numbers are so high. I think that the comparable companies are like Broadcom, AMD, Qualcomm, Texas Instruments, Intel. Those are the true peers, in my opinion. And I owned TSM for multiple years. I did great with TSM. I went up 200% on the stock. It was great. So, and I sold it, and then it came down, and I've never been back in TSM.
So half 54% of the revenue is these top 5 companies. 80% of the revenue for all semiconductors is the top 10, the top 11. So I don't know. It's so hard to like use logic when you talk about a company like this. So they represent 17% of the revenue, but 49% of the market cap. But they do have 46% of the free cash flow. So I guess it's justified, right?
Yeah.
But if you look at a company like Taiwan, actually Taiwan is across the board pretty close. Taiwan represents 14% of the market cap for all semiconductors, 15% of the revenue, 17% of the free cash flow. So actually, Taiwan looks like it's valued appropriately.
Yeah, I do value Taiwan Semiconductor, and I believe they're overpriced by let's see, TSM. I think they're overpriced by 55%. Because they really have you've seen their stock price go up substantially since the AI hype started. And again, TSM does not own the IP. They just manufacture. They're the foundry. So NVIDIA sends an order and says, make me 1,000 of these, and they produce them. And it's a profitable business, but it's not nearly as profitable as NVIDIA, who says, hey, I'm going to be at 80% margin on this chip because I own the intellectual property. TSM is more like, hey, we're at 30-40% margin. So it's a different animal, and their stock is really, it's gone up 62% in 1 year. And I'm not quite sure how much it's gone up since really NVIDIA started taking off in 2020, at the end of 2022, beginning of 2023.
So according to this, the best deals in the semiconductor market, if you live in a vacuum and you don't have any knowledge of the outside world, like about trends and hype and things like that, just by the strict numbers, the best deals are Broadcom and Qualcomm, because Broadcom, I'm just basing it off of free cash flow and market cap. Broadcom represents 21% of the free cash flow for all semiconductors, but only 11% of the market cap, which indicates that it's undervalued, right? Because if they represent 20% of free cash flow and 11% of market cap, that means the stock should go up, right?
Yep.
Same thing with Qualcomm, is they represent 14% of free cash flow, but only 4% of the market cap.
So I owned Broadcom and sold at the end of 2023, and I owned Qualcomm, and I just sold it a couple weeks ago, and saw the same thing and thought it was a good buy when I bought them, and I made a good return on both.
Yeah. So my strategy is, if I find a good company, it's hold forever. Sometimes I do buy companies that I think are great, and then I lose faith in it, like what happened with Intel. So I sell it. But I generally try to hold forever, and usually there's no regrets, unless of course the stock goes down. But if it keeps going up, then I don't get upset, because sometimes, like Victor was saying, he sold the stock, I think you said Broadcom, and it went up a lot more, and then you're kicking yourself. So that's why I have a hard time selling.
There's two. I mean, right? Like you can invest in stocks a million different ways, and really, I think investing should fit who you are, and it should fit your strengths. It should fit your instinctual kind of how you make money, right? I've made certain investments that really paid off, that aligned a couple of things. One is my analysis, my intuition, my understanding, all those things lined up. And when a stock like TSM, I bought it at the right time, I held it long term. It started trading above where I thought it was worth, and I'm like sitting there on a big gain, and I sold it all. And it went down in 2022, everything went down, right? So I kind of felt like, hey, I did the right thing on that one stock. Now, Broadcom is kind of a similar story. I saw NVIDIA just screaming up in 2023. And I'm like, well, I need a piece of the action. So I bought Broadcom, and I bought big. And I'm like, well, this AI story, I don't believe in. That's what my intuition's telling me, obviously. So I sold at a really big gain. And I'm like, well, I still see Qualcomm as being underappreciated. And Qualcomm did have business problems, and they were seeing the iPhone sales struggle, which meant it was a direct correlation to their revenue struggles. And they were getting through that. So I bought it at the right time, held it for like 3-4 months, and then sold it at a really good gain. In 3-4 months, I made 40%. Okay, great. So again, I need to continue to kind of like, this is my style. It's not any, I always say in my videos, don't do what I'm doing. Figure out what you can do best, and then go do it and keep learning, and you'll be a great investor. And that's what I saw. That's what I'm seeing. And that's why I'm acting on it. A buy and hold forever, I'm not that smart. Maybe there are people like that can say, like, Warren Buffett is legendary, but I think we take things way too literal. Like he started buying Coke, 30 or 40 years ago? The investing environment was completely different, and good for him. He's buying, his cost basis on Coca-Cola is like nothing, and he makes a big dividend and so forth. Buying and hold forever is just too difficult. I can't tell you if Alphabet's going to be the best company in 20 years. And I can tell you that Alphabet's one of my longest standing, holdings. But if I got into a period where, you know what, Alphabet's losing it, they're beginning to really lose, their magic, their competitive advantage, their intellect, they're losing a bunch of people. I might cut my position in half and say, hey, you know what? It's been a good ride. Cut it in half. Or Meta, right? It took a lot, well, it didn't take a lot in 2022, frankly, because I still saw those beautiful cash flows from Meta. And I kept believing in their financials. Like, there's just no way this company is being treated poorly in the press, but I stayed in it. But Amazon is a good example. I made money on Amazon. I feel like the stock price has gotten ahead of where the true value of the company is. I don't like that they're in, 100 different types of businesses. And I got out of Amazon. So it fits like what I'm trying to do. And I just find making a commitment that I'll own a stock forever is just too much of a commitment. I'll own it and continue to analyze every quarterly earnings. And when the theme changes on that stock, when I stop believing in the company or I think the industry there's something wrong, I have to revisit the sell option. I'm saying, okay, do I want to get out of this thing now? Is it overpriced? Is maybe the conditions changed tremendously where I'd be better off in cash for the next year instead of being in that stock? That's what I go through.
Yeah, this is an interesting thing with NVIDIA. I don't really use this. I use this website a lot, but I don't use this section too much. But look at the institutional ownership, because the smart money is with institutions, and I'm not saying they know everything, but generally they have a lot more information and a lot more history to work with, and capital too. But look at institutional ownership in NVIDIA. It was almost 80%, and look how much institutions trimmed.
Wow.
And they keep trimming down, which is really rare for especially a big company. Usually they have institutional ownership 50, 60, 70, 80, sometimes over 90%.
What is it showing? What's it rated? Because it's really small on my end. I can't really see it.
You mean the percentages here?
Yeah, I can't see it. It's kind of blurry on my side. Is it like 10%?
So the institutions back in 2021, they own 80% of the company, but now it's the street that owns it. Only institutions own 7% of the company now.
No way.
And they're not increasing their ownership.
So it's mainly like retail investors are in NVIDIA?
Yeah, which is crazy. I've never seen this before. Because you can see institutions, but also look at insiders. They're not. This doesn't seem right. Insiders are getting rid of their shares, but this goes way back. So sometimes you have to take this stuff with a grain of salt, I guess, because
let me look at another source, because that number is like super low. Like I'm like, wow, man. Institutions on NVIDIA. I mean, I'm hearing that a lot of hedge funds are in it, but that could be wrong.
Insiders in the past year, it's only selling. Nobody's buying on the inside. And it's so high. And I think even the people who work there are like, it's too high. Of course, you want to support your company and buy it, but at some point you do have to take some money in. You worked hard, probably maybe 10, 20 years at this company. You deserve, but no one on the inside is buying it because.
So I asked Gemini, Alphabet's AI, and it said 65% of shares are owned by institutions.
Yeah, Simply Wall Street says 67%. I wonder if this.
Yeah, that number is so low. I was like, holy smokes. That's like GameStop. That's like GameStop territory.
Yeah, I wonder why it says this. I wonder if I'm reading this wrong or if it's just chart's wrong.
Yeah, I would agree with the other source you referenced. What was it, Wall Street?
Yeah.
Because I mean, Gemini is pretty good, right? And ChatGPT is pretty good too around data sets like this. It's pretty good.
7%.
And this is
Maybe
reported by NASDAQ. So I'm willing to guess that that's pretty good data.
Yeah, no, it's maybe they just mean hedge funds or something. I don't know. Yes. So sometimes when you read this stuff, just you might not be accurate.
Well, yeah, we'll see. The I read a kind of switching topics around the same theme.
Yeah.
I read a really good article on the Wall Street Journal, and they usually have pretty good articles that kind of pull me away from the details of analyzing a company here or there. And they're the article is called "Investors Fear Long Stretch of Calm in Markets Can't Last." So what they reference is we're seeing, and I don't think anybody would argue that you're seeing a couple of stocks really rally, and they're the stocks that are keeping the stock market index going higher, and not substantially, but just keeps going higher. Meanwhile, a lot of stocks are really falling behind. If you look at the Russell, I think it's in negative territory for 2024. And there's a calmness there, and that's freaking out all the professional investors. They're like, this is the setup to a big correction, because we've seen that in other periods that resemble this calmness. It's setting up a pretty good correction. So read that article if you want to. It came out today, and I read it.
Yeah, it's the calmness. When will that correction be? Sometimes the correction happens and we don't even realize it happened. It's that minimal. COVID was an obvious correction.
Yeah, that one's easy. It's like, oh, industries are going to be shut down. Oh, okay, it's a crash. That one's like, okay, nobody argued with that one. But like the one that happened even ahead of the .com bubble, people were like, ooh, euphoria, man. Internet's going to revolutionize the world. And then slam. Or even as we went into the subprime mortgage meltdown, Michael Burry came out and shorted the mortgage industry. I mean, talk about shorting something that's super duper boring. That's what he shorted, and he was right. And it caused this collateral collapse of financial institutions. Well, there was kind of euphoria going into that period where people felt wealthy because their home prices were going up and a bunch of other factors. And we've ever since the subprime mortgage meltdown, and I'm going to kind of take COVID out of the picture because COVID, we can kind of look at it and say, okay, that was a true correction, but we can explain why is we had a pandemic. And the rest of the years, have been up years, and that's kind of unnatural.
Yeah. No, that was, but I think unless it's like a world-ending thing like COVID, these corrections, they don't come around too often, and you don't know when they're gonna come around. They sneak up on you. Like even though the mortgage thing, it was kind of it did build up, but no one really understood it until it blew up. Then everybody's an expert on the mortgage market, and everybody understands why after the fact. But who knows? But if the world ends like a COVID ending kind of thing, well, people think, oh my God, we're all gonna die. Those things will kill the market, but they're brief. That was like they don't last that long because it's not really based on fundamentals. But no, it's
So maybe you want to take some stock suggestions from the audience and see if we can comment on those, or what would you like to do next?
Yeah. Okay. Yeah. If anybody wants to throw out some stocks, I guess we'll go another 10, 15 minutes. I think somebody mentioned REITs earlier. What do you think about REITs? Hey, Blade, Paycom. $8 billion market cap. They pay a dividend. That's generally when you know a company is probably in a decent shape when they can pay a dividend. It gives a good indication to the market that we're doing okay. We're giving a little back. They had to, like, everything seems to have this peak in 2021, like right after COVID, like it just everything ran up, and it's come down like 75% since that peak. So what's the bottom? Like, man. So they're trading at 2019 levels. Are they going to get down to? So let's see. Let's look at the fundamentals. So revenue doubled since 2020. They're profitable. That's a good industry.
Software.
Like just like a PayPal kind of industry. Like when you just take a fee.
They're more like an application software company, like handling back office functions. They do human resources management, like the HR back office capabilities. They're more of a software company. PayPal is more of a financial services company, in my opinion.
Okay. So I didn't even exactly realize what they did. So it's a payroll and HR company. So yeah, they just do the back office. So they support a lot of companies, because some companies don't want to hire someone to just do, HR, payroll, and those types of tasks. Just outsource it to a company like this. And then you can have like your CFO or the CEO just handle these companies. Just provide these companies the info they need so they can run the numbers. And they did a good job with it. 1.7 billion in revenue.
The founder. So this company came up on my live stream either about a week ago, and I dug into it, and man, the company looks good. The founder, he was co-founder, forgot the business, but it was a successful business. So he co-founded a business. They went IPO, or they sold off to a bigger business, and it was a successful, beginning and exit strategy. And the same guy started this company, which is really set up to serve small businesses and give them payroll services as well as HR services, which are a necessity to businesses. And if you look at their revenue, they've been growing. Their growth has slowed down. The law of big numbers, right? The bigger you get, the harder it is to grow at those same percentages. But their stock price, which has been amazing, from like what you said, from 2021 to this point, it's down big. And it's like, what gives? They keep growing. They're cash flow generating. So what is it? What is holding down this stock?
So yeah, if you ever like, because looking at the stock price is one way to like understand how the companies did historically, but you should really compare the stock price to something else. Because if a company's stock price went down 80%, but their revenue and profits went up 80%, that's significant. But if a company's stock price went down 80% and their revenue and profits went down a similar amount, then it makes sense why they came down. But look at the PE. It was almost 180 at the peak. That was at the end of 2020.
Uh-huh.
But this is what happens. Companies get super overvalued because of all this buying hype,
Uh-huh.
and you can't grow at these massive rates. It's just impossible. I mean, 200, almost 180 times earnings. Like how much you have to grow to maintain? Like it's just so it comes down, and now they're at an appropriate level, 17,
and that's below the average of the S&P. And it's a growing company, which means if it's a growing company, it deserves a better PE because it's a growth company. So this one here, and then their balance sheet looks okay. So I'm like, what's wrong with this company that investors don't like it? They don't have any debt, but they have close to 300 million in cash. They produce free cash flow. So I couldn't put my finger on what's wrong with this picture. It looks way too off.
I could see anything with this company. I think they're going to be trading sideways for a really long time. There is definitely some upside potential, but I don't see the massive growth.
The one thing that could be
down to like 12, I think I would maybe pick it up.
You can't predict this, but this is a pretty good takeover target. It's like, okay, they're growing their revenues. They have good cash on the balance sheet. They produce free cash flow. I'm a bigger software company. I'm going to acquire this business, which produces $1.7 billion in revenue right now, and make my $20 billion company 10% larger. So it's a good takeover target because the valuation is so low, and they are selling into a part of the business that is kind of their specialty is selling into small businesses. So the big giant software companies, Microsoft and all, they don't really pay attention to the small businesses. These guys do. So they're probably doing quite well in that small business segment.
Yeah. So like what's a good PE? Like, what do you guys think? It's hard because usually if you try to go with PE and you go, okay, I'm going to buy only stocks below 20 PE. Sometimes it's better just to go with the high PE. But you don't want to hold it too long, though. That's a problem. You're going to get burned if you buy a 100 PE company.
Well, if you understand the story, right? If you understand that, let's say this company is going to continue to grow at 30, 40%. They're already a pretty good sized company, and they have a 36 PE, 40 PE, like an Uber, right? Uber, ahead of some of its fundamentals, it was like at 100, 200 PE, but it was just beginning to get profitable. So it was like, hey, they're going to fill in those metrics. But for now, I'm okay with that PE because I understand the Uber story. And over time, they're in a industry that didn't exist 15, 20 years ago. And this company didn't exist 15, 20 years ago. So they're kind of disrupting all these other industries and forming their total addressable market. So in a company like Uber, I'm willing to kind of ignore PE if I understand the story and I see the path to free cash flow, because PE could be misleading if the company's generating free cash, but they're unprofitable, right? That could be misleading. It's like, wait a second, this company's generating a ton of free cash because 5 years ago they had to invest, let's say, $100 billion in their infrastructure. Well, that's already been spent. And now they're having to expense it against their financials because they are going to depreciate it over 10 years. So I tend to make sure I understand the story of the company first. And then the PE is just maybe more evidence that it's a good company, but I'm willing to ignore it.
Yeah. It's PE is weird. There was a long time where PE was everything. Then people were like, PE is waste. Don't look at PE. It's a combination of a lot of things. It's hard to know the right formula because every company is different. But it looks like an interesting company. It looks.
One side note for software. the super focus on AI and infrastructure, meaning, computer chips, has pulled a lot of money away from software. So I bought Adobe less than a month ago, and Adobe had a really good earnings and the stock popped. I'm up 9% on Adobe in less than a month. Adobe is a great software company. It's one of my top 10 software companies, and I've bought and sold Adobe and made money. So what I would say about Paycom is they're getting this like software isn't as cool as it used to be treatment, and they're a small business, and they had that big stock price collapse. So I think investors look at that stock chart and go, wow, what's wrong with this situation? I don't want to buy something that's going to go bankrupt or something. So I think that's what's going on with Paycom, but I may not be able to resist. And at some point, maybe if we do have a correction and this stock gets down even further, I might have to pick up some shares.
Yeah, there's so many stocks. Every time I do a video, I'm like, this looks pretty good. Not every time, but a lot of companies I'm looking, I'm like, but you can't like invest in everything. You only have so much money.
Yep. I have a question for you, if I may ask.
Yeah.
So let's say we're talking about software, and in your portfolio, how many of the same industry companies are you willing to hold in your portfolio? Are you a believer that this is the one company in this industry I believe in, and that's the only one I'm going to invest in? Or it's like, I believe in this space, I'm willing to own 3 of them?
No, I think it's good, especially if you really understand an industry or you like an industry. I don't see a problem investing in multiple companies in the same industry, because usually the best way to, I think, a great way to grow and scale is to have a lot of competition, because it's just more marketing for the industry. Because if you're the only person in your town selling something, people think, oh, that's the best thing. You're the only one selling it. But then eventually people start thinking, well, what do I need it? If it was so great, there would be, a lot of companies selling the product. Maybe it's creating awareness, things like that. So I think, I don't think there's a problem owning, definitely. If it's a hot industry, you can really take advantage of that. And who knows which company is going to be the super growth one. Like if you knew for a fact, if I told you 5 years ago, semiconductors are going to be the best thing in the world, but you can't put like all your money into one stock, because you don't know if Intuit was the king. Even 5 years ago, Intuit was really strong. Intel was really strong, but who knows which one? So you kind of have to spread it around, and hopefully you put more into NVIDIA.
Yeah. I'm like you in that respect, where if I believe in a space, and like, I think, getting away from maybe the common topics, what's going to work in 2025, what's going to work in 2026. Like, I continue to think that, hey, industrials are probably going to work, because we have an economy that's been, in my opinion, sluggish. And now we're kind of getting through a sluggish period, and we're going to start to see growth, especially in industrials, in the right industrials, right? And I believe in that space. I might buy 3-4 stocks that represent that space, and then watch them, right? Like every quarter, look at them at least once, better look at them twice, really rethink through what is the story that I'm expecting in this industry, and look for evidence that, that story is beginning to take shape, and these stocks are going to be worth a lot more in a year. Or, hey, the story that I thought was going to happen, I think I was wrong. I need to get out of these positions. And one company may really begin to, like, I started getting into healthcare, and I think biotech's a really good space, because biotech could be a really good growth area. And I bought 3 growth biotechs. 2 of them are doing great, and one of them was not doing great. So I got rid of the not doing great one. And I continued to pour money in the other 2. and the other two are doing great. So I'm going to keep pouring money in those.
Yeah. I mean, sometimes you find a great industry, it doesn't have to be a great company, a great industry, and, you can make a lot of money. But yeah, I wish I did that with semiconductors. I never heard of this company, Bell Fuse, electronic components. I think it's 800 million market cap. Revenue peaked in 2022 at 650 million. It's down to 600 million. I wonder why revenue came down. They're profitable, and they have a PE of 10, I think.
Yeah, I'm seeing that. They were founded in 1949. Wow, and they're in New Jersey. Okay, so they're an old school. Even before it was called semiconductor, it was called microcircuits. And so, yeah, electronic circuits back in the before they became these tiny, they're getting down to atom level, circuits.
Yeah.
They were more larger circuits that were still relatively small, but nowhere to the density that you're seeing current, semiconductors. So that's the era that these guys operated in. And these guys are probably feeding kind of older industries that still use these older technologies.
And I know some people wouldn't invest in such a small company, but if you think about it, 99.9% of companies out there are smaller than a company with 866 million market cap. Not many in the world I'm talking about. A lot of companies operate and are profitable for a long time and never become publicly traded companies. So it's not like you're investing in a startup kind of company. I mean, how many people can grow a company to 600 million of annual revenue?
Yeah, but this one here, what I don't like is they were founded in 1949, right? So it's not like they were founded 10 years ago and they've gotten to 600 million. So, okay, in how many years is that? 75 years, you've gotten to 600 million. It's okay.
Right.
That's to me, that's kind of like a story that to me has more signals of problems. Okay, you're not relevant. If you were relevant and you've been around for 75 years, you ought to be a $10 billion company, $25 billion company. But you're pretty small.
Yeah, no. So it takes a little more due diligence to figure it out. Was the original company? Sometimes a company starts out and does something totally different, and then it gets acquired by someone who kind of transforms things. So yeah, you want to do a little due diligence to understand things better.
Like 3M, right? 3M now is considered a really impressive company with products that are impressive. 3M stands for the Minnesota Mining Company. They were a mining company. They mined for materials and then they would take them to market. But their founders thought, hey, we got to keep changing and evolving. And now they're a respected company that is in different technologies. They're an industrial stock that produces a lot of products that people respect. And I really respect the 3M brand. But that's what you're saying is a business might start in one industry and evolve. And next thing you know, like General Electric, right? They were a power producer way back when Thomas Edison was roaming the earth. And the light bulb was kind of technology back then. Now General Electric's creating turbines for airplanes, and they got a healthcare business, and they got this. So that evolution is interesting to follow.
Yeah. And it's almost like they're totally different companies. Even if a company sometimes has the same founder with the company, but if you look at a company in 1960 compared to 1980, compared to 2000, sometimes that's so different. You can't even really compare. You can't even look at ratios because it was like Berkshire Hathaway. You can't, with a textile company, it's total. It's totally different now. So you can't compare their fundamentals today or a lot of companies. So that's why when you do a DCF, you generally don't go out like 20, 30, 40 years, because it's just it's impossible to predict that far into the future. Same thing as looking in the past. It's just like, it's night and day. You can't compare a company from 1950 to 2000, because the technology was,
Yeah, 3M was founded in 1902. So after 122 years, they evolved from being a mining company. And I'm sure 120 years ago, the mining industry was pretty relevant, right? Because we were trying to get the materials to build cities and factories and stuff. But it's pretty cool that they've evolved. And there's companies that also take this type of evolution and continue to stay relevant.
Yeah. No, it's interesting. Sometimes I think about doing videos about. I've seen people do videos about the evolution of companies, and I think it's really interesting how companies change and evolve over time. I'm sure it's even more interesting if you were part of that company too, and seeing the changes. Okay. You want to wrap it up? I'm kind of getting hungry.
Yeah, I'm good. Thanks for having me. It's nice to talk with fellow investors and just kind of talk out loud what I've been thinking all week. So I really appreciate the opportunity to talk with you.
Yeah, definitely. Yeah, it's always fun, and I'm sure I will be doing it again in the near future.
Yeah, and if we do have a correction, if I can get a green light, that we'll get on a live stream and talk about it.
Of course, we have to.
And then I'll do my NVIDIA like short kind of update, and maybe next time we talk, I'll show the details of my NVIDIA short position, good or bad. Hey, I'll show it out there, and people could see. That was a risky move, and it really backfired, and I'm losing 20%. Okay. Or maybe, hey, it's beginning to kind of do what I think it was going to do, and we'll see. I'm going to look at it once a month. I'm not going to look at it every day because it'll drive me crazy.
I hear you. Yeah, I know that feeling. Okay, well, thanks again, everybody, for commenting and watching. Listen to the Acquire podcast. Yeah, and next week I'll probably see you again, but try to watch the videos I put out if you can, and comment on those, and check out Victor's channel as well. So enjoy the rest of your day, everybody.
Thanks, Scott.
Okay.
See you again. See you guys.
Okay, bye.